Good evening and good morning, and welcome back to the new era of agriculture commodity trade. Welcome to the session 3, day 4 of Commodity Week World 2026 or CWW26. Let me just do a mic and visual check. Neeraj, am I visible and audible?
Yes, loud and clear.
Perfect. So early today, this global marathon explored the intense crush margins pressures across the Asian Pacific corridor before tracking the sun to Europe, Middle East, and Africa theater to map out European demand and the evolving African processing pipeline. Now our journey arrives at the ultimate Western powerhouse of global trade. We are turning our full focus to the primary engine of supply, the industrial transformation hub of the world. Welcome to the Oilseeds and Vegetable Oils North and South America War Room. The agriculture value chain has crossed a critical threshold. The traditional playbook, the one that relied on predictable crop cycles, stable freight corridors, and reliable trade alliances, have officially expired. Trade is no longer observing cyclical market corrections. Operations are running within a baseline of permanent structural volatility. Over the next 2 days, our technical session will continue bringing the global boardroom directly to your screen. CWW26, organized by HnyB and Know Your Commodity, is presented by AgriGuru Online and is supported by Kripko Agri, Bajrang Group International, and Bingani Group, along with our association partners, UATA Myanmar, Ukraine Pulses and Soybean Association, and GOPKI Indonesia. Other institutional partners include Solidarad and World Cooperation Economic Forum. CWW26 is moving entirely beyond the delayed data of historical balance sheet and presentation. This is an unscripted, unfiltered war room. The mission is to democratize the high-stake market intelligence, mitigate the systemic risk of information asymmetry, and equip you with the foresight needed to defend your margins and ensure equity for producers and consumers alike. As a reminder, these sessions are beamed live across multiple digital assets on LinkedIn, YouTube, X or Twitter, Facebook, and our own event website. Let's have a macro view. While grain represents the baseline of caloric survival, oilseed and vegetable oils are the ultimate drivers of agriculture processing margins and the primary target of the global energy transition. The energy sector has rapidly emerged as the fiercest competitor for food and feed, including widespread feedstock anxiety across the globe. Globally, the oilseed balance sheet is expanding to meet this demand, but supplies remain incredibly tight relative to consumption. Global major oilseed production is forecast to increase by 19.6 million tons to a record 718.1 million metric tons. Let's look at the breakdown of these numbers. Soybean production represents the vast majority of this global expansion, rising nearly 14.0 million metric tons, driven heavily by production gains in Brazil and the United States and Argentina. Concurrently, the global sunflower seed production is set to increase by 7 million metric tons, supported by acreage and yield recoveries across major growing zones, including Argentina. While global rapeseed area is growing by 4%, global production is only expanding by 1% by something around 1.4 million metric tons, as primary producer return to trend yields after previous highs. On the processing and trade side, combined global oilseed crush for major varieties is projected to increase by 4% on back of relentless product demand. However, the true complexity of the global balance sheet lies in the structural revolution transforming the global soya complex. Strong demand for vegetable oil as a biofuel feedstock is completely anchoring the domestic supplies in major production nations, shifting historical trade patterns and drastically limiting the volume traditionally available for foreign export market. To understand how these massive supply side transformation, domestic crush demands, and bioenergy mandate translates into physical trade risk, we must look directly at the heavyweights of the Western Hemisphere, which bring us directly to our third panel of the day. Welcome to the Americas Theater, the production heavyweights and the mandate shots. Here in North and South America, the oilseeds and vegetable oil narrative is defined by raw production scale, domestic crushing expansions, and industrial policy mandates that alter the global trade balance overnight. Let's break down the critical Americas pressure point. First, United States supply and biofuel anchor. The US soybean crop is projected at 4.435 billion bushel, up 173 million from the prior year on trend yields and higher harvested area. Total US soybean crush is projected to scale to something around 2.75 billion bushel, driven by highly favorable crush margins and intense domestic demand for soybean oil as a biofuel feedstock. Total US soybean oil demand is forecasted to jump by 7%, which is lifted by the EPA's renewable volume obligation to massive 17.8 billion pounds for the biofuel alone, a major 3.6 billion pound increase over the previous year. Now, second, Brazil. Brazil's production scale and export is dominating the world. Brazil continued to solidify its position as a premier global supplier for soybean, with production projected to expand to roughly between 182 to 186 million tons. Global soybean exports are forecasted to rise for Brazil and Uruguay, keeping South America export availability at center of the global trade flows. Third, the Argentina, it is a processing engine and export pivots towards meal more than the seeds. It is absolute fulcrum of global soybean meal as well as oil export. According to the tables, Argentina soybean production is projected to rebound to roughly 50 million metric ton, with domestic crush volume targeted at 43 million metric tons. Now, the days of relying on lagging monthly report to make multi-million dollar procurement or hedging decisions are over. Navigating this massive supply side engine requires elite ground level foresight. We are going to accept that foresight right now. We have assembled an elite strike force of North and South American oilseed expert and trade expert. We have originators managing volatile deep water export campaigns, the analysts decoding the real-time adjustment of the global balance sheet, and the commercial leaders who are managing and processing multiple oilseed. And with that, our mandate for this session remains simple: no script, no filters, pure intelligence. We are going to dissect the America's production metrics, analyze the true export capacities, and also we have to see what are the cash margin. For our audience, please do engage with our data and prepare to rethink your coverage strategies. The market does not wait, and neither you should. With that, welcome to the session 3 of day 4 at the Commodity Week World 2026. Let's officially open the oilseeds and vegetable oils North and South America War Room. With that, I would like to welcome my first speaker, Amy Hinton. Hi, Amy. Amy, you're on mute. You're on mute if you're speaking.
Hi, good morning. Sorry about that. Having a few tech issues this morning. How are you, Deepak?
All good, all good. Thanks a lot, Amy, for joining. Let me first introduce you. So Amy is an expert commodity journalist and media executive serving as regional managing editor for agriculture and biofuels at Fast Markets, bringing a sophisticated cross-sectoral approach derived from previous roles as an international banking analyst and metals reporter. She directs global pricing and market development coverage. Her core expertise centers on the safeguarding the absolute integrity of price discovery methodologies and providing clear and transparent benchmarks that guide global energy and agriculture trading network. So, Amy, pleasure to have you. Let me shoot my first question to you. So, how does your cross-sectoral background in banking and metal influence your approach to safeguarding the price discovery methodologies in agriculture and biofuel?
Well, first and foremost, Deepak, thank you so much for having me. It's been a really great opportunity to speak with you guys. So thank you for the wonderful introduction. I am the regional managing editor of agriculture and biofuels for the Americas at Fast Markets. But I've only been in the role a relatively short time. That said, I've been with Fast Markets for almost 8 years in a variety of roles, managing and pricing and analysing a variety of commodities. I started with Fast Markets in January of 2019, working in London on base metals, then moved to the United States, where I'm now based, where I managed the Americas scrap team. So I've spent a lot of time in commodities. I spent most of my 20s in banking, working mainly in middle office functions, risk and compliance. And I have had a really interesting career, and I've really enjoyed working with commodities in various guises for most of my career. I will say that even though I'm new to the ags and biofuels space, the robust methodological principles that Fast Markets employs really govern every price assessment or index that Fast Markets produces. So while commodity, one could be covering a different commodity at any time, the actual stringent methodological application process and the basic tenets of price reporting never change. My time in risk management has really made me acutely sensitive to the need for robust checks and balances when it comes to working with commodities and financial markets, particularly as we're regulated. So it's very important that we can defend our prices and that they are published with integrity. Prior to joining the Ags and Biofuels team in the middle of April, I actually headed up a team that managed a very aggressive benchmark. And since the ags and biofuels vertical within Fast Markets is comprised of multiple legacy publications, including one with the cachet of the Jacobson, which has been reliably pricing many of our existing markets since 1865 and brings multiple legacy benchmarks. I actually feel like I'm very well positioned to manage those also, based on my prior experience. We have a very robust team here, spread across the Americas, and extending into LATAM, and it's an exciting role to be in. And I do feel that I'm well placed to be in this space now. I've certainly learned a lot since mid-April.
Awesome. That's really great. Good to know, actually, and I always believe, the fundamentals, if they are there, then definitely, rest of the things fall in place, and the right methodologies are what are important. So as energy and agriculture market aggressively, as you have covered energy and agriculture market aggressively, what are the biggest challenge in providing clear, transparent benchmark for global trading network with respect to biofuels and energy is now dovetailed into oilseed, right? In Indonesia, we are talking about biofuels from say the edible oil from palm being used as biofuel, going to the mandate of 50% blending. Similarly, in US also, we are seeing that the soybean oil is being used as I would say biodiesel after processing. How do you see that energy market being impacted by the edible oil and the oil seed value chains?
Well, great question. And firstly, I'd like to speak to the portion about the challenges.
Sure.
And we're certainly all living through and dealing with periods of high volatility within the commodity space and changing market fundamentals, actually. It's a really interesting but also challenging time to be within the market. To start off with, the challenges that govern us in price reporting and analysing the markets are akin to those that beset the market itself. In some instances, although we're approaching them from an analytical perspective and we're not trading those markets, it's sort of two sides of the same coin. The fast-moving nature of news as it pertains to trade policy and macro development is particularly pertinent in the current climate. As I said, we're all dealing with a high level of volatility. We're glued to the wires. Information comes out regularly at the moment that's roiling oil markets and having a knock-on effect for biofuels and feedstocks. News out of the Middle East this morning that Israel and Lebanon have signed a ceasefire. No doubt that's going to have an impact on market perceptions of the US and Iran and the potential for peace talks to finally develop into something concretized there. And that will all have a trickle-on effect. So it's all very fast moving, and we're always sort of at the crease, as it were, to use a cricketing term. We need to be abreast of these developments, both in terms of coverage and from a pricing standpoint, whilst also maintaining the reliability and integrity of our data. So it's all about striking a balance between breaking news, bringing reliable analysis to the market, but also ensuring that we're robust in our due diligence. That really is of paramount importance. And I'm sure, as you can imagine, when things are moving quickly, it can be hard to strike a balance between bringing the market the information it needs, but also making sure that it's following our methodology application principles, that it's robust, that it's been produced with integrity, and most importantly, that it's accurate. Again, to touch on some of the recent developments that we've seen roiling markets, we've got the US-Iran war, which is roiling energy markets, having a big impact on biofuels and feedstocks. We had news on Tuesday that the US is now considering tariffs on Brazilian and Chinese imports, which will potentially have implications for soybeans. Bullish if Brazil tallow exports into the US are curtailed, and bearish if China retaliates and reneges on plans to import US soybeans. So these are all things that we're constantly keeping an eye on. We've seen a lot of whipsawing, but we're constantly engaged. And I wanted now to touch on your excellent point about the convergence of agricultural and biofuel energy markets. We're really well placed to deal with the convergence of agriculture and biofuels markets. And this is not only due to our increasing focus on biofuels. We've got a constant eye. We're seeing really interesting things happening. RIN values are at record highs. They keep notching up day on day, based on, the RVO information that came out in March, which was, record volumes. But the main thing I'd like to point to is that we have real existing strength in feedstock markets. And our understanding of those streams is really embedded along the supply chain, and it's complementary of the direction that the market is now taking. So we can look at the emergent and in some cases dominant uses of feedstocks from a biofuels perspective in the current climate, which is, where most of the buzz is centered and what's driving particularly soil demand. We see it very closely following crude oil futures, but we'd also see it reacting to feedstock demand and policy shifts in that space. But we also understand on the flip side of that coin that there are more traditional uses for those agricultural products, and that allows us to be really balanced in our view. So, for example, we are pricing soy oil, but we're also pricing soy meal. We're not just pricing tallow, but we're also pricing meat and bone meal. So we're very well embedded. I hope that answers your question, at
Yeah,
least to a degree.
No, totally it answers. And actually, you just pointed recent developments, like, one was on the tariff under 301, like, 60 countries have been put on those tariff, and retaliation, I hope it's bound to happen, that's normal. At the same time, we are also seeing that, like, the conflict also erupting and becoming a little bit a bigger challenge. And we are seeing that actually, like, there has been a huge shortage or also reduction in the SRPs of US itself, right? The oil stock are going down. Do you think that at some point, like, the biofuel become more prominent, like, export from Europe or from the US? Because crude is a challenge, right? It's after August, I don't see, like, if the things continue the same way, US would have sufficient crude to even export.
I think a lot will depend. I think it's very hard to take a position on that in the current climate. I think if I were able to answer that question cogently, I'd probably, and I say this a lot when it comes to outlooks, I probably would be on a beach in the Bahamas if I had the answer to that question. I think I'd like to plead the fifth on that and come back to you when we've got some clarity on the Strait of Hormuz and the conflict, and how things are going to play out with the traditional exports versus what we can expect out of the US. But I think it's too precarious a time to actually make a call on that.
Frankly, on the lighter side, if we ban Twitter, Truth Social, and Facebook, I think majority of the world's geopolitical problem will get solved. Now, policies
I
are
agree.
being on the social media rather than in actually, like, White House or on, like, in some parliament somewhere. So that brings me to another interesting question. How do you ensure that the global pricing coverage accurately reflects the growing market premium for certified, traceable, and sustainable oilseed? Right, that is all something which has been pretty difficult so far.
Well, that's a great question. And I'm going to take another high level approach, because this, as it pertains to soy oils, soybeans, any oilseed volumes, would be a principle that would be applied across the board at fast markets, which is one of the things that makes us so robust. It's a very level playing field in terms of how we produce data. But we're all dealing with high levels of volatility regardless. So in a climate such as this, it's really essential that we remain close to the market whilst also maintaining our role as an ancillary and auxiliary function. And what I mean by that is that we are a function and a tool of the market, but we're not part of the market. So it's important to maintain that distinction and to maintain our impartiality, which is really important. When it's important that people realize that we're impartial, we're not signaling, we're not, we're setting tradable commodity price levels, we're bringing analysis, but it's, we are not part of the market and we're not trying to influence. And I would say that relationship management is actually at the core of what we do, as is integrity. And our methodology application principles, I know I've referred to them previously, allow us really to transform those relationships into tangible, usable data. Again, talking about recent developments since the trade war kicked off last year, we've actually already tailored our approach to pricing and data across multiple commodities to ensure that we're bringing the market reliable and accurate pricing data. Soybeans are actually a really good example of this that I'd like to highlight. We actually modified our China soybean assessment, which encompasses tonnages imported from the United States, to embed additional tariffs that were levied, so that we capture the price and competitiveness of that market versus others. So taking steps like that, so changing tools to befit the actual state that the market's in, can actually be really revealing as well. As in that instance, it threw into light that US pricing, which we also offer, was not more competitive than Brazilian pricing on that basis. And it threw that pricing relationship into stark relief. And it's information like that and making changes like that in real time that actually give our subscribers an edge. So there's some, I feel like that probably describes to you the process from inception to having a relationship, gathering the data, all the way down the line to actually making changes for the market and making sure that we're at the cutting edge. I hope that answers your question.
No, totally, it does answer my question. A pretty interesting take. I think overall coverage and understanding of the process itself, like give the confidence that actually when you arrive at price, right, you always get the price, which actually you can bank on, and that is what I believe the fast market is all about, right? That validated right information, which can actually make you take call irrespective of size of the call. Now coming to another very pertinent question, that what emerging market development in biofuel sector do you believe is currently underpriced or misunderstood by traditional agriculture trading networks?
So I've got a few examples here, but to speak more generally, and again, great question. We're seeing lots of emerging regional biofuels policies, and on the basis of that, we're seeing new dynamics emerging, and the breaking of existing market correlations that have been, traded and embedded for a long time. And we are always looking to assess the extent to which there is potential for new benchmarks to emerge, and obviously for us to price them. And the example that I would highlight here is actually soybean oil export premiums in Brazil and Argentina. So those premiums are currently trading around record lows, but the market actually still uses Chicago futures as a hedging tool to hedge in those markets, because it's traditionally what has been done, and those values have been well correlated. But based on recent developments, we're seeing that relationship, that those markets bifurcating. So while that market and those of Brazil and Argentina diverge, it actually might be a good time to consider new market pricing mechanisms for biofuels in Brazil. And we certainly see Latin America as a big developing market upon which we can expand our existing offering. Another really good example of how we've already achieved this would be the launch we had of a regional hedging tool in India, which is obviously the largest consumer of cooking oils. Together with the CME, Chicago Mercantile Exchange, we launched a contract for soy oil and palm oil on a CIF basis to India, which has seen trading, I'm really happy to say, and is a really great example of recent pricing tool development that was done to befit the changing needs of the market. So I'll conclude by saying I've given a high-level view. I don't want to give too much away in terms of market development and what we're up to next. But to that, I would urge people to get in touch if they want to know more and to contact me. I'm always happy to talk markets, to take feedback, and to build more relationships as I move on in my tenure in agriculture and biofuels. I'm really happy to be operational in the space.
No, I'm a pleasure to connect with you, and looking forward to have more such interactions, and wish you all the best. I know agriculture is a pretty difficult area to be in, and especially in the scenario we are in. On one hand, we are seeing geopolitics playing in multiple regions. Very rarely it has happened of post-World War II that in Black Sea as well as in West Asia, two locations you are having live war going on. Then we are having approaching El Nino. Right, and this El Nino is also not actually something which is mild. It is considered to be one of the strongest El Nino, right, which has been seen in nearly a couple of decades. So that is another challenge. At the same time, we are seeing after a long time the overall stocks or carryovers of a lot of agriculture commodity being at cyclical low. Rice 6-year low, wheat after a long time, after 4 to 5 years, I think first time we'll be having more consumption than production. While in Latin America, sunflower is giving a respite, it is giving respite in European Union, but I don't think that overall soybean production also is to the level where actually it was historically last year. So a lot of challenge, and welcome to the chaos, right? Living with chaos always make you stronger, because I always believe that if something doesn't kill you, it will give you immunity, right? COVID did me lot of good by giving me immunity. So looking forward to have more engagement, and thanks a lot for joining. It's a pleasure to have you on this event.
Thank you so much for having me. I've really enjoyed it, and I'm looking forward to engaging with you all again soon.
Perfect. Looking forward. So with that, we go to our next speaker, and it was a pleasure to have our next speaker, Mr. Juan Camilo. Mr. Juan Camilo Ribech Soto, that's his full name, is Managing Director and founder of Veg Oils Colombia, an independent palm and soya oil advisory and brokerage firm. In the sector since 2012, he operates at the intersection of 4 domains rarely combined in one seat: physical trading, supply chain and logistics, a deep network among Colombia and Latin America's leading commercial actors, and sectoral governance. Built over 3 consecutive terms, 2018 to December 2023, on the boards of director of Colombia's Palm Development Fund, FFP, and Price Stabilization Fund, FEP. His practice optimizes South American supply chains, links environmental governance with agriculture productivity, and aligns physical trade with RSPO, ISCC, and organic mandates from European, North American, and Asian buyers. His recurring voice on the Latin America's crush margins and Colombia's role as a sustainability differentiated origin. Welcome, Juan. Pleasure to have you, sir.
It's a pleasure, Deepak. Thanks for this invitation. I'm really excited to be here today and with you and with all your the people is with us in this space. I would like to add something. I have been working in the palm oil for the last 14 years, and in different and several areas of the supply chain, general management, and today I'm working as the managing founder, as you say. So it's a pleasure to be here. It's an honor to have this space to share some thoughts about the palm oil Latin America, and to have some this opportunity to talk about all these opportunity that we have in the supply chain of the palm oil.
Perfect. So, Juan, in fact, like in the morning, we had a great session where we had Asian speaker, people from the government of India, Indonesian GOPKI, which is actually government supported, promoted association for palm there. We had SD Guterres, CEO. All of them were actually talking about that Indonesia will definitely squeeze, right, palm oil supplies. There is a possibility that huge amount of palm oil might get diverted for the 50% mandate which they are having. And that shrinks the overall availability of palm oil going forward. Now, in your view, I would like to understand, how does the balance sheet of palm oil looks like in Latin America, especially because Colombia is the only and the largest producer of palm oil in this part of the world. Your views on how the supply chain, supply and demand looks like in your region, sir?
Well, I can say that there is more palm than ever, but produced on almost the same land, and the Americas play a small but very specific role in this picture, you know? Based on the USDA data, I should say that the global palm oil is going to be for this season, for this 2026 and 27 season, is going to be around 81.3 million tons. And this is going to be another record because last year we have another one. And all this is happening in only an increment of 0.3% of the area. When you ask me about the Latin American production, I can say that we are producing 5.7 million tons. And this is going to happen in 1.7 million hectares. If you see, this is only the 7% of all the global palm oil output, and this is happening in a very tiny footprint. When you see the top 5 producers that concentrate the 90% of all the Latin output, you will see that Colombia, Guatemala, Brazil, Honduras, and Ecuador represent this amount of this volume of palm oil. In the case of the productivity of this region, we have that Guatemala is leading the world with 5 tons of oil per hectare per year. Colombia is just under that, it's below that number, it is 3.8, and it is over the global average, that it is around 3 tons. To give you an idea, the exportation from Latin America and for the Americas in general, again, from this 26-27 season, is going to be around 2 million tons. Guatemala is the leader with Colombia and Honduras in these exportations. In the importations area, we can say that the region, and I'm meaning all the Americas, is importing around 3.5 million tons. And all the consumption here, it is around 7.3 million tons. The biggest pools here in all the Americas are United States, Colombia, Brazil, and Mexico. Something that I consider relevant for the conversation, and I'm going to talk about these 2 points during our conversation, because I consider it is important for the people to know, is first, Colombia and Ecuador has around 200,000 hectares already harvested, dedicated to a new variety that we have here in Latin America, and it is called a high lake. It is around 0.3% of all the planted area in the world. It is a small area, but it is relevant, and I will show you. I would like to share some slides about this because I consider it important for the people that it is joining us in this conversation to know about this type of oil. And the other point here is that, well, our federation just confirmed a few months ago that Colombia is in the final stage of the ICAO approval, so we will have a certified feedstock for SAF. As you know, this is going to be confirmed in the second half of 2026. If this happens as it is expected, Colombia would become the first palm origin in the world certified for SAF. So I consider this relevant for this conversation because this is part of what the world is looking for, and it is what we need in the world. If you don't mind, I would like to share you.
Please. Yeah, share the presentation. I think you'll have access, not a problem.
I need now. It's not available yet. And sending the request, maybe. Okay, let me try to show it to you. Do you see my presentation? Deepak?
Yes, Juan, it's visible.
Okay. So let me tell you about this because, as I told you, I consider it relevant, and this is part of our conversation. Colombia has growers achieving yields around 10 tons of oil per hectare per year. The average in the world, based on the US data, it's around 2.92 tons of oil per hectare per year. This new variety, it is having a very good yield, and we have to check what is happening with this because it is what the world needs. So we are having right now 641,000 planted hectares. Last year we have 1.93 million tons of CTO. The total area that we have in production is the 86%. And this is what I'm trying to show you. This high lake is 21% of all the area in Colombia. As I mentioned before, we have the 3.8 tons of oil per hectare per year in the yield in the average of the country. But if you see here in the southwest, we have a 4.3 tons of oil per hectare per year. This area is only dedicated to this high lake. When you make a specific zoom in the eastern area, this is the average of all the production, that it is 3.9. But when you check only the high lake, you will see that you have 4.8 tons of oil per hectare per year. And I consider this relevant, as I told you. And let me tell you why. When you are trying to fractionate to have more olein, this is the solution. When you are working with the typical palm oil, the Guinensis, you will have at least 65, 70% of olein during your fractionation process, and you need to do it 3 times in order to get a top olein. I am showing you this because the high lake, first, you can have up to 90% of olein in just one fractionation process. You will have a top olein in just one fractionation. And you can have twice as many phytonutrients like carotene and vitamin E than the typical palm oil that you can have in the rest of the world. And you have this picture, those are my hands. You have a picture of the type of fruit. You have the typical Guineensis and you have the hyoleic. And you see in the other side of the picture, you will have this, we call it capybaras here, in a plantation. So you can have sustainability, productivity, and more oil in less land. This is part of what I want to share with you today. And this is what I'm trying to show to our people that it is connected right now.
Awesome. No, I think it's a real innovation and future looks great. And as you rightly mentioned, the sustainable aviation fuel has been a challenge, and if we are able to solve that problem, right, it is going to be great for all of us. Let me get into another question to you, I think, which is very important as well. So how do you see challenges around Asian palm market impacting South American players? See, one part is the supply and demand and shrinking of Indonesia. But do you see that actually the challenges around Asian palm might creep into the thought process of Latin America also? Again, same, the mandates, the thought process, nationalization of resources, all those things comes on the table.
Well, let me try to summarize this in 5 points. I guess the palm oil market in a few years will be shaped by 5 forces moving at the same time. Latin America initially we will be well positioned for all of them, but only if we can read the signals in the right way. First, I guess everybody during these sessions has been talking about this. A strong El Nino, maybe a super Nino is highly likely in coming months. I believe that it will cut the peak production in Indonesia and Malaysia. Everybody knows here that these two countries are producing the 85% of the world. I guess we will have less supply and with higher price. I guess these are bullish news. Second, I guess the biodiesel mandates, they are eating a lot of local supply. Indonesia is moving to the B50. I don't know if it's going to happen this year. Well, we're talking about B45, B50 in following month.
So, Joan, let me just add one line here. So today we were having Indonesian counterparts in the first session we had, and they've confirmed that actually by middle of this year, B50 is going to become a reality. So that is they're pretty serious.
Yes, I have here in all the news about that. I know this is coming. I don't have, as you told, this a good news coming with this. This means that we will be using around 4 million tons of oil in the biodiesel process. Malaysia is moving from this June to the B50. So we are going to use around 0.3 million tons in addition. In the case of Colombia, we are staying in the B10. This is very predictable. We are using around 0.7 million tons for the production of the biodiesel here. It is around the 45% of the local demand. In the third point that I want to talk is the UDR, as everybody knows, well, for the large companies, I think that we will all will be ready by December of this year. But I believe that this new regulation is going to have a lot of problems with the independent smallholders in Asia, basically, because there are around 3.5 million growers that we will have a massive problem because they will be excluded from the European Union, and all this oil will be rerouted to Asia and Africa. Latin America, by contrast, I guess it is ready. Colombia is at least with the 83% of the area already mapped. And Honduras, Guatemala, Ecuador, just to mention some, they have been doing very serious work too. So it is going to be a real competitive advantage for Latin America. For the 4th point I would like to mention is the aging plantation. Indonesia and Malaysia need to replant at least 0.8 million hectares per year. And based on the data we can collect, I guess we are having something around 0.2 million hectares. So that gap is going to depress the yields for the for the next years. And in the case of Latin America, I can say that we have younger plantations and active replanting with all this active replanting that we have been doing during these years. Maybe we don't have this situation. And the last but not the least important, the quality and certifications. I guess Europe keeps raising the bar with this chlorine, much more traceability, and I guess that today we have around 20% of all the global palm oil area certified in RSPO. Latin America is around the 30%, and Colombia is doing the homework or the task in a very good way also. So what we have here in Latin America is a market with young plantations, with controlled deforestation, certified volumes, and quality that it is fitting to Europe. And something that it is important to mention, it is we are close to this market. We are 18 to 20 days away from this market. In the case of Indonesia or Malaysia, it is around 45 to 60 days to go there. And this is something that it is important for relevant for the conversation. From my point of view, what we are having as a customers here are basically Europe, Brazil, US, Mexico, and lately we have been doing business with Africa and India, and I'm talking about Latin America because these markets are growing as buyers. So I guess for the next 2 years, this will be a window of opportunity, and the question here is, we are ready to step into it or not?
Perfect. Juan, so last parting question to you, as an advisor, right? What would be your strategy which you would tell your client to take in palm? Do you think actually somebody should go long on palm? There is a possible good upside from here?
Would you please repeat the question? I didn't follow with the last part.
Okay. As an advisor to a trading fraternity, what would be your advice? Do you think that people should go long on palm in current scenario? Or do you see that actually there could be some structural bearish trend as well around the corner? Because whatever we are hearing, it looks very bullish. But do you think there is a possibility that the prices can still go further down when you go long?
That is a really good question. What we have, all the information that we have the Super Niño coming, or at least the Niño. You have an increase in the demand on this biofuels policy, and you have, from my point of view, you will have less inventories. So I guess we can have a bullish position here. What we have here right now is an opportunity for the people to place some orders, because with this war having place today, with this Iran, US, and Israel, I think that we will have for some month from now, we will still have some good prices. I cannot say this is going to be forever, but from my point of view, we can have a good opportunity.
Perfect, Juan. I also believe that. In fact, of late, China is aggressively buying palm oil from Indonesia and Malaysia already. I don't know how they are always ahead of the curve. Chinese are always ahead of the curve.
And also, if you see what it is happening with this soybean, with all this U.S. policy about the biofuels, you have a very good spread with palm oil and U.S. Soybean. So it is a good opportunity for the palm oil, and also for all the oleins, and for this to remain in a good price, or based on what we have now of information. It can change, yes, but now I consider bullish.
Perfect, Juan. Thanks a lot. It was a pleasure to have you, and it was always great to hear deep, insightful data from people like you who have been wearing multiple hats. Thank you.
It's been a pleasure. It's good to be here, and I hope that we can help with anything you need in the future.
100% looking forward. So with that, we move to our next speaker. So we are having Tor Alden. Tor is a premier agriculture market researcher and founding partner at Round Lakes Commodities in the United States. With over 25 years of commercial experience in commodity advisory services, he is a leading authority on structural supply and demand modeling and balance sheet forecasting for grains and oilseed. He's highly celebrated across institutional network for his incisive predictive analysis of USDA data, helping commercial hedgers identify market turning points ahead of price action. So I think Tor is going to be presenting. Good morning, Tor. Pleasure to have you.
Good morning. Thanks so much for having me, and apologize for the odd green background. It's I used to have my computer turned around, and so there's like a big glass wall behind me. And if I don't do that, you get the witness protection version of me, where my face is all darked out. So, but very happy to be here and happy to present.
Yeah, please.
I'm going to talk a little bit about what I've been doing essentially since I've left fast markets, and bear with me just 1 second here. And then how that also relates to the crushing industry and what we're talking about today. So I left fast markets about a year ago, and part of the reason that I left was I could see sort of where I thought AI was going and what AI could do. I could also see the frustration of trying to build what I thought I needed to build at fast markets. And so when I first put this presentation together, I thought that this title was clever, and now I think probably a lot of people have used a title like this or a version of this title. And I think the lesson that that analysts en masse are probably not going to be replaced by AI is one that people have learned. However, analysts that are augmented by AI probably are. And so I want to talk a little bit about what I've been building, and then I'll talk some about Crush and about the current market and what's going on, but I'll hustle through this really quickly. So essentially, throughout my career, I've always had a bunch of spreadsheets and a bunch of data needs, and I've always wanted to automate all that, and I've never been able to do that. And so I think, like a lot of analysts, anytime something changes, I spend my time looking at data, pulling data, getting data into spreadsheets, changing those spreadsheets, and then writing about my forecast and why it's changed. AI promises to revolutionize the way that I and every analyst work. And we can use sort of a real world example here from recently, which is the conflict in Iran. Conflict kicked off on a Friday night. If I was in my old job, I would have spent the weekend sort of revising my outlook and my forecast. But what we're doing is we're setting up a system that not only feeds the data into our old models, so into our old spreadsheet models like we've always had, but it also has facilities for every facility in the country. So for a crusher, we have a facility that is an AI agent for that crusher. And what it does is it wakes up every morning and it looks at the price that it has expected versus the cash price, and then it makes a decision to buy or sell based on that difference and a couple of other things that I'll kind of get into. But then aggregating all of those transactions then gives us a different way to forecast than I have in the past. Typically, I would do sort of heavy seasonal forecasting and then kind of focus on the annual numbers. This is going to be more of a bottom-up and top-down approach, because ultimately the facility agents' actions are governed by a risk budget that gets set each quarter by another LLM. But we'll get into more of that. Either way, the Iran war starts, and I spend my weekend going through spreadsheets. With our new system, in part because of the data automation, I don't necessarily have to do that, but there is still some there are still some things that are required from a human. AI can't do it all. AI has to What I've learned about AI is that AI is not that smart. LLMs are not that smart. They are fast. Before I worked at Fast Markets, we were at the Jacobson and we worked with the University of Minnesota. They have a AI machine learning program, and what they do is in the final semester of the students' program, they work with real world companies on AI projects. And so we used that as sort of a long form interview. Our project was to predict soybean oil prices, which we didn't really think we were going to accomplish by hiring 4 grad students. If it was that easy, sort of everybody would do it. But we wanted to learn about AI, and so we've been looking at this for quite a while. And the thing that is clear is that if I have an LLM generate a report, even given the improvements that we've seen in the past 6 months or whatever, it still is not going to be that great. It's much better than it was a year ago, 2 years ago, certainly. But in terms of me just sort of setting this up and walking away and never having to come back, that doesn't really happen. However, when something does change, I don't have to go through all of this stuff that I would typically have to go through in order to have a reasonable and sensible opinion about what's going on in the marketplace. And so this part just kind of goes through what most analysts know as well as they know anything, which is sort of the split between the mechanical work of getting data in and changing forecasts, and then the actual analysis part. And really, you can see this is kind of backwards. This is 3 hours of copying and pasting data and 45 minutes of analysis. It really should be the other way. And in the way that you can do it now, given how good Claude is at coding, is you can essentially do almost all analysis and very little of the old data copying and data management. And so this is what you sort of need to think of as you go through something like a war starting on the weekend. And you can't skip a step, and it doesn't really, it's not really something that you can just sort of breeze through. It's something that you have to think a while about. With AI, what happens is a lot of that, again, grunt work can be done, and then AI can write a summary for you, and then you can talk to it about what you think about the changes that it suggests and the changes that you want to make. These are just some statistics about our particular project, and these are actually kind of old now. Even the nodes on our knowledge graph are over 500 now, and same with the causal relationships. These things are when you build an AI model, one of the advantages, but one of the tough parts is that you have to sort of encode your experience and knowledge. That's a big advantage because every place that I've ever worked, all of the assets for that employer walk out of the door every afternoon when the day is done. Now, the knowledge graph essentially tries to encode all of the information that I have in my brain. And there are ways that you can do that. You can write these out by hand, which I kind of thought I had to do. And what I would suggest is if you do want to build one of these things, that you start getting used to this idea of just sort of as you think about sort of the relationships between any two markets or any two data series in your mind, you should write down how you think about it. I happen to be a pack rat, and so I literally have everything that I've written over the past 28 years, plus things that people have given me. A senior analyst earlier in my career gave me a very nice chart book with his handwritten notes on charts for every contract for every year. And I fed all of that into the LLM to build the knowledge graph. But one of the lessons we learned from AI is when you think you want to start working on AI, you are probably a year or two away because you have to do a lot of this kind of background work that sets the data and the relationships up in a way that the LLMs can actually use it to be productive. And these are simple things like a drought reduces yields, then that has an impact on prices and on acreage relationships and on and on. But this is one of the big components that is critical to get right if you're going to build an AI model like this. All of our data is essentially automated now. I've always wanted to have my data automated. I've had some version of automation that ranged from Informa was relatively good at it. Fast markets didn't really have it so much, but now, again, thanks to Claude, all of our data is automated and it all comes in. So this is just a very small sample of the data sources that we use. We use all of the sources that we typically would have used in the past, and they all just sort of pop in. And then this is, as you go through the weekend, this is kind of what you would spend Sunday doing if I was an analyst 3 years ago. I would have spent my Sunday that weekend writing commentary after having spent Saturday going through the models and changing all of my forecasts. With the new system, I don't really need to do that on Sunday night. I can get a summary of what the LLM thinks. And in our system, I maintain a set of spreadsheets and models, and the LLM maintains a set of spreadsheets and models. We compare and contrast our forecasts, and we talk about why we're different in some places. And that hopefully over time allows both of us to get better at forecasting these markets. Again, this is a longer presentation, so I apologize. So it beats you over the head about some of this stuff a little bit. The part in here that I think is interesting is the 187,000 lines of code. That is now well over 250,000. I'm not a coder. I took the Python course through Coursera and completed it, but I never really had a need to use it. And so when I started to do this, initially I asked ChatGPT, and then I used Grok for a little while, and then I finally settled on Claude. And Claude UI can code faster than humans because it knows all the languages, it has GitHub and everything. And if you use UI, it will also debug it for you. And so something that I could have built when I was at Informa or Fast Markets working with a programmer would have had a workflow that was like, I need to have my trade flows automated. He goes off and he does that. I look at the results and then I give him feedback. Throughout that, there's probably a couple of days between when he finishes and when I look at the results, another couple of days between when I give him the feedback and when he gets back to it, and we probably have to go through that process maybe a couple of times. With Claude UI, it literally happens in like 10, 15 minutes because it does all of that checking, and at the end, all I really do is check the data to make sure that it's accurate. Okay, a little bit more about the knowledge graph. Again, this is one of the two areas that are really key to our model. This one is key to everybody's model, and really the underlying point here is that if this is what you want to do, you need to start figuring out a way to get what's in your head onto paper. If you have everything that you've written, you can feed it into an LLM and it will generate these. If not, what you're trying to do is establish the causal relationships, the if-then questions. If this happens, then what happens kind of thing. And when that happens, the LLM becomes smarter because it has a roadmap that it can follow. So the LLM on its own may not know, it certainly should know that drought leads to lower yields, leads to higher prices, but it may not have some of the secondary and tertiary effects of that drought. And not everything is as straightforward as a drought either. One of the classics is, while droughts do reduce yields broadly, for soybeans, if you get rain at the right time, you can have an awful looking soybean crop that yields really, really well. And in fact, a little stress early in the season is generally good for most plants that are fruit producing or seed producing, because it indicates to the plant that it doesn't need to build a pretty plant, it just needs the genetics to survive. And so the plants end up focusing more on producing seeds than they do on growing a huge 6-foot canopy. So this is the three comparisons that we do in terms of modeling. I keep a set of balance sheets, the AI keeps a set of balance sheets, and then of course we reconcile to USDA in the end. We can be in front of USDA, and I tell people a lot, it can be easy to beat USDA in certain situations because USDA analysts on some level know that the market is going to react to the changes in their outlook. And so they tend to take more of a stepwise approach to major changes, whereas I can just rip the major change in and talk about why I think that's what it is. And I'm not going to affect the market in the same way that USDA did. But the real strength in this, I think, is being able to compare what AI thinks and what I think and talk about the reasons why we're different and sort of reconcile that and then move forward. Again, this just sort of beats on the idea that AI is more efficient, which of course it is. One of the things that we went through when I was putting this together was kind of like, what are we selling? And on some level, somebody suggested that we're selling sleep is what we're actually selling. Because if you know that you don't have to go through all of your models over the weekend and that you are confident in the analysis that comes out of the LLM, then you get to sleep, which is something that has not happened a lot over probably the course of any of our careers. The five big things that we took away from this, you have to have domain expertise. There are a lot of companies right now, I think, that are hiring a lot of data scientists with the idea that if you can discover the relationships, then you can model it and you can analyze it. That's true on some level, but I've worked with data scientists quite a bit, and without the hands-on knowledge and expertise, the relationships that are there may be spurious, or they may actually be meaningful, but without somebody that has experience, it's very hard to know which is which. The idea is, and the big one for me was always trade flows. So trade flows were the first thing that I wanted to get automated. And I got deep into this project, and I didn't even know that I needed a knowledge graph. So I thought I was ready to start publishing and start to open. And then I figured out that I needed a knowledge graph. And so then I had to build that and do all of that. Anybody that's coded knows you're going to have failures and problems, and it takes a long time. The other part is your knowledge graph will never be sort of complete. You can always feed it more information. The way that it works is sort of a voting system, a weighted voting system. And so it takes a while to establish something as sort of a fact, but it takes at least that much feedback against that to deny that and change it in the way that it models. So these are sort of some of the areas that we're going to cover. We're starting in biomass-based diesel feedstocks because that's generally what I covered at Fast Markets. But the system that we're building literally has every facility that touches any of the any of the biomass-based diesel value chain. So all of the crushers, all of the slaughterhouses, trains, barges, the competitive buyers, the sort of Unilevers or oleochemical companies also are in the system and have LLM agents that wake up and make the same economic decisions that the buyers at these companies wake up and make every day. And the idea is that by modeling everything and the way that we've set it up, it's essentially live. So if you wanted to do due diligence, you wouldn't pay me to write a long report. We would just create a new facility. So if you want to put a crush facility in Illinois, we would create a crush facility in Illinois. And then the model actually works in real time to react to that facility. The other facility's bids will adjust, and instead of me writing a report, a bunch of blogs that will come out that will show you what happens because that facility's there. We have real detailed financial models for all of these facilities because we go in and we pull all of their environmental permits. So we know exactly what kind of equipment they have, and we can get their cost to fairly high accuracy. In the end, we also will work with people in the industry to calibrate those results to make sure that they are correct for that particular facility, and then we hope we can generalize that to other similar facilities. And so in the end, we will not only cover sort of the traditional biomass-based diesel feedstock markets, but we'll cover corn and wheat, and we'll actually cover FCOJ because I used to cover FCOJ and I have a soft spot in my heart for it. Okay, so that's the AI. Very quickly, I will just say that from my perspective in the US right now, really the crush industry and in the broader oilseed industry is really a function of the biofuel mandates, as it has been over the past 5 years. However, the Set 2 step is going to be a much larger jump in production. And so it is going to continue to support prices and make everything tighter. To your question to the previous presenter about whether he would be bullish palm oil or not, I think that all of the feedstocks have the potential to be bullish. And so I don't know that I would want to be short any of these, right? I think I don't know that I'm going to go buy futures, but I may go buy lottery ticket out of the money calls or something like that. If I'm a trader, if I'm a hedger, then I want to just hedge against that risk, and so I may buy out of the money calls just as cheap sort of insurance. Planning is underway. So far, we haven't really had any problems. I think it's hard for U.S. farmers to have problems these days. They can plant so much of the crop in a week that unless you have a 2019 style flood, they really can get it done in just a couple of weeks generally. And so don't anticipate any problems. We will have a big crop, and it does look like you probably, in the US, you probably get tight a little bit in soybeans depending on the yields over the next year or two. But I think that a lot of whether it gets tight or not will depend on exactly how much crushing capacity comes online relative to the size of the U.S. crop. The U.S. is going to give up exports in soybeans to Brazil. It's already happening, and despite any efforts, I think, from the current administration to try to get China to buy more soybeans from the U.S., I doubt that they will do that in a way that is significant, not sort of window dressing, because Brazil has gotten in there and taken a fair share of the U.S. shipments. That said, the crush industry is happy to take those beans, and the basis that you see across the country really reflects that the strength of that ongoing demand.
Thank you,
All right.
Tor. It was
Thank you.
awesome. I loved your presentation, and maybe offline we'll chat. We are also back home in India doing something of that sort. Only challenge here is that actually in India, the data is humongous because we deal through not corporates. India is having a specialized in every sub-district, a place called Mandi, which is actually an aggregation center where a farmer comes and brings the product. And it is bought by the government, it is bought by the intermediaries, by the traders, by the processors. So it's pretty complex, and every day you generate millions of lines of data. And that is I would say that though healthy for AI, but very costly as well, because more data you crunch, which is having a lot of outliers collected by human beings, a bigger challenge it is. So we will talk offline, and pleasure talking to you. And thanks a lot for a great presentation, Tor. Thank you.
No, my pleasure. My pleasure, for sure.
So now we are having our last presenter today, or last speaker today, Joao Pedro. Joao Pedro is a specialized senior agriculture analyst serving at Helios AI in Brazil. He focuses on the rapidly evolving intersection of renewable energy mandates, regulatory frameworks, and agriculture feedstock like soya and corn. His expertise lies in modeling South American trade flows, analyzing real-time price discovery mechanisms, and delivering data-driven insight to help global participant navigate the structural shifting balance between food and fuel production. Welcome, Joa.
Hello, Deepak. Thank you so much for the invitation. I'm super happy to be here and walk us through a little bit of our views at Helios of how the Americas continent is changing its soybean market dynamics. We have been seeing some pretty interesting stuff in the past years, and 2026 has been this amazing year that everything is possible and everything is going on at the same time. So yeah, thank you for having me.
Yeah, so according to how is the rapidly evolving regulatory framework for biofuels in Brazil actively dictating the South American soybean trade flows, in your view?
Yeah, so let me share my screen
Yeah,
over
please.
here.
Yeah,
Um,
your screen is visible. Yeah, it is visible.
yes, all right.
If you can go full
So,
screen, full screen, that would
yes.
be, yeah, perfect. Now it's on. Cool. Go ahead, please.
Um, all right. So, I'd like to start going through what is happening in South America and especially in Brazil. Um, we are currently at a major transformation in the market dynamics. And Brazil has been the key player in South America in this transformation. And it's quite interesting to analyze and see the two distinct paths that Argentina and Brazil has taken in the past decades, and that is now getting deepened into this market position. Brazil try to seize the opportunity of biofuels and to enhance its industrial policy through biofuels. And it's quite interesting because there's currently a consensus here in the country that biofuels is the path of one enhancing the value capture of the industry chain, but also to make the industrial complex more relevant into the Brazilian GDP. And so because of this consensus, we had this really positive and fostering environment, not only through the industry, but also from the regulatory landscape. And that was reflected in 2024. In 2024, Brazil has passed the Fuel of the Future law, which is a landmark on the biofuel policy since the 70s, which we established our ethanol program. It is the biggest policy landmark regarding on biofuels. And basically, what that means is that we lock it into a steady and legally scheduled biodiesel mandate increase, which we should get into a B20 by 2030. We will have a 1 percentage point increase per year up to a B20. However, now the discussions domestically has been like B20 is taken, and now we are discussing if B25 will be a option, maybe by 2030 or a little bit further. So we have the super pro biofuels policy framework down here that was just passed in 2024. Not only increasing biodiesel and ethanol mandates, but also fostering the first steps of our industry into second generation biofuels. So next year, Brazil will kick in its sustainable aviation fuel mandate, which will be quite interesting and is fostering lots of discussions down here. Not only discussions, but investments also into SAF capacity. We'll have also our renewable diesel mandate kicking in by 2027. So it's quite interesting because this is not only deepening our strengths in the first generation biofuels, but also locking our first steps into the second generation fuels with the Strait of Hormuz and the oil shock that we are currently living. It strengthened the biofuel case down here in Brazil. Brazil was one of the countries that had less fuel inflation because of our higher blending mandates. It worth noting that Brazil has ethanol since the 70s, 1975, and we have E100 ethanol available in our pumps. So our cars engines are built to run both in gas, which already has a high ethanol mandate, but also we have our cars can run completely on ethanol, and that just is strengthening the biofuel case because now our policymakers are looking at biofuels, and they are seeing not only a economic engine to the country development, but also a resilience to absorb the external shocks. So moving to the current outlook of soybeans. Well, Brazil once again harvest a record-breaking crop of 180, 185, depending on who you are looking at the estimates, and it's on its way to harvest again a record-breaking crop. US will also have a big crop. We had on the on the end of March, the planning intentions report with U.S. farmers claiming a acreage increase of 4% in the U.S. on beans. And it's quite interesting because Brazil and US are kind of taking the same route. So both countries are increasing their production, although the US has this acreage constraint that Brazil doesn't really have it. But they're crushing at both countries at record pacing levels, exporting meal as much as they can as well. And then we have this divergence on the soybeans exports. Brazil is on a in this year exports program has been quite strong. We shipped like last week we had customs data out pointing to a 51.6 million ton exported through Jan to May, which is a record for the window. May alone was 15 mil tons, which is it was on the way of a single month record. So it's amazing the volumes that we are exporting, and this is well opportunistic buying from China, really discounted beans from Brazil because of our huge crop, and certainly Trump's tweets are helping Brazil its exports program since 2016, but it helped in the past years or so. We had Trump's visiting Xi a couple of weeks ago. On my views, the market haven't really reacted a lot. On my view, it is the Chinese commitment was reaffirmed, not expanded. We should expect more of a goodwill purchases from the Chinese state companies like COFCO instead of being a structural shift because private crushers doesn't have the margins importing US beans. So it doesn't really make sense to them, especially right now with crushing margins above that reached $4 last week per bushel in the US. Crushers have more and more incentives to keep their beans domestically, and I think that's gonna happen. But at the same time, we have Argentina, with Brazil taking this route of becoming more and more of a domestic market in its soybean oil industry. Argentina will reaffirm its position as the major global soybean oil supplier. I expect that for the coming years, as Brazil is withdrawing its exports from the global market, and Brazil and Argentina will be there to fill in the gaps that both Brazil and US, with the Set 2 rules that will increase quite sharply US soybean oil usage in biofuel production. These two countries will leave gaps that Argentina more than able to fill in. It's worth highlighting that Argentina has set its industry into a exportable structure, so they are quite ready to absorb this. Um, and what we are seeing right now, and since the beginning of 2026, is this huge widening of spreads. We have basically the US bullish biofuel policy through the new RVOs. Then you have Hermes and the soybean oil correlation with oil prices, which basically send out soybean oil from 50 cents per pound in early, reaching almost 80 cents per pound this week. So it's quite a change, and I think there's two components into that. There's the conjuncture. So we have a war, we have an oil shock, a energy complex shock prices. So that would naturally lift prices higher. But also we have the structural change of one, the US. You have, from out of the three major soybean oil producers, two of them, Brazil and US, are increasing quite sharply their feedstock demand through their biofuel programs. But also you have in the US this qualitative change in their biofuel, in their framework, that is the withdrawal of the indirect land use charge from soybean oil in the 45Z carbon intensity assessment, which means that before, when they first proposed 45Z credit program, that credit would be that the credit generation would be related into the carbon intensity of the feedstock used in the biofuel production. So waste feedstocks like used cooking oil, tallow became really appealing to the markets, and we started to saw actually a premium, those feedstocks and trading at a premium over soybean oil prices in 2025. But then you have the withdrawal of the ILUC, the indirect land use charge, that made soybean oil as competitive as these other low CI feedstocks in credit generation under the 45Z. So this is a structural change, because basically what that means is that the policymakers are saying, let's use America first feedstocks, let's make soybean oil great again, and let's increase share of soybean oil in our feedstock mix. That way we can both support US farmers, but not only that, but also increasing our domestic energetic production. We don't rely that much and into external sources, and therefore we are more resilient to external shocks. And as you can see it over here in the other slide, we have Brazil increasing its bean oil usage for diesel production quite heavily. We increased it. We went from nearly 6 million tons of oil used in 2022 to more than nearly 10 last year. This year we are also running at record-breaking paces. And we expect that Brazil never lived at such a. I have been saying that since 2024 that Brazil is living this momentum in its biofuel industry, but certainly 2026 is a key year that is really reaffirming the strength of the industry and how it's perceived domestically. So just to wrap up, this is what we are seeing. Mandates. We are seeing a policy-driven change that is changing the whole dynamics of the continent, but also how the continent interplay with the rest of the world. So Brazil, we're not closing, but we're certainly internalizing our supplies. Will still be the largest soybean exporters, but we also will crush as much as we can. And we have several announcements of investments in our crushing capacity throughout the next years. We have investments announcements in the biofuel capacity as well. What that means is that we'll see a more aggressive competition internally between exporters and domestic bidders. And we will certainly see soy oil kind of being stuck at this one or maybe even a little bit less, but like 0.8 million tons to 1.4 range in the coming years. In the US, same kind of similar dynamics. We'll see more with a shock with this change from the RVOs from the last couple of years and the current RVOs, because it's a huge increase. But what we'll also see is the US crushing more and more and redirecting its soybeans supply into their crushing industry. And in Argentina, as I said, this whole policy-driven changes of Brazilian and US markets will reaffirm Argentina as the major global supplier for soybean for the whole oilseed complex. Yeah, so that was it. That's what I brought for you guys. Thanks again, Deepak. Was really nice being here.
Yeah, thanks a lot, Joe. It's a pleasure to have you, and thank you.
Thank you. Bye.
Bye. So with that,
sorry.
actually, no, I'm good. So with that, we come to an end of this interesting session on oilseed and veg oil, covering North and South America. And with that, we thank all of our panelists, our audience, our partners who have been there and who have been listening patiently since morning, this is the third session since morning. And I hope you would have learned a lot. Definitely, I have learned a lot. We talked about the palm from Asia, specifically Indonesia and Malaysia. We talked about India's demand. We talked about Africa's soya push towards India. We talked about the European Union's new emerging demands, needs, regulations. And finally, we talked about how the world's biggest production engine in Americas, that's North and South America, for oilseed has been working. With that, I would like to sign off as your moderator. Thanks a lot for joining us. See you tomorrow, where we will be talking about pulses, and then day after when we'll be talking about